Good morning. This is Corey Schrader, the investment trainer, also founder and CEO of Black Creek Wealth Management. Just wanted to take a little bit of some time, get you some trading and investing information for the week of January 10th, 2022. Crazy enough. So we're in the second trading week. Wanted to get you a little bit of some information on what I see going on for the trading week, as well as what some of the things you can start thinking about from an investment perspective as we start getting through this pretty interesting January. So wanted to share the actual some thoughts and screens with you today to show you a little bit about what I'm thinking about and what I'm looking at as we move into this week. But before we go about this week, let's talk about what happened last week. So if y'all were watching and trading like I was, stocks had a pretty rough week. A lot of money flowed out of your growth companies, moved into a lot of your value companies. So move from things with high price to earnings multiples into things with lower multiples, price to earnings specifically. So NASDAQ fell for a fourth straight session on Friday, which was its worst week since February. It's almost a year prior. And again, moving from those high-tech names into lower, more consistent cyclicals because of rising interest rates. Benchmark on the 10-year, which is almost like a catalyst or almost like a ballast with what's going on with tech. It hit 1.8 at its highest on Friday, settled out about 1.77. This morning, it was right around 1.7. So as interest rates are starting to rise, tech is starting to feel a little bit of some of that stress. But here's what I'm thinking about when it comes to this, because from a tech perspective, the reason why tech's getting hit so bad is because of borrowing costs. Because at the end of the day, a tech company, in theory, needs to borrow more money to be able to promote growth, put in more R&D, and get more of those things from that money that they're borrowing. So obviously, the higher their interest rates, the higher their borrowing costs, usually the lower the ability to get growth or lower ability to get higher earnings per share, which everyone loves to have. So when we look at what's going on, at the end of the day, people are concerned that higher interest rates are going to hit these growth companies. Well, I'm going to tell you first and foremost, this is the thought that I have is you have Apple that has $62 billion in cash as of their last balance sheet. You have Google with 136 billion in cash. You have Microsoft at 130 billion in cash. These companies are down 10, 9. Apple's not down as much, but they're down because of interest rates. Well, if you have that much money in cash, do you really need to borrow any money? I don't know. Those are kind of some interesting thoughts, right? So my belief as we kind of move into this year with higher interest rates, I still think there's going to be a level of a cap on where interest rates are going to get to, somewhere around 2.25 by the end of the year. So we have about a 50 basis point move that we could see throughout this year, which tells me that maybe we're over correcting a little bit here, but I'm going to touch a little bit on that a little bit later. But I think the high quality large cap tech names are going to continue to still go at a good pace and still have a good run this year. However, the general market and theme is let's sell now, think about it later. And then if everything corrects, which it typically does here at the beginning of the year, then we're going to see that piggyback rally at the end of the year. So what I want to show you first off is, if you can see the charts here, this is the triple Qs, or basically the top 100 NASDAQ companies in the US. So ultimately, you can see this is the last 3 years, okay? It has been on a tear over the last 3 years. And that's not necessarily a bad thing, but it also tells me that we do need to see a level of correction to some degree to put us back in some sort of stability mindset. This is the S&P 500. Same story, different house, right? So we've just seen a complete run here. And if you're interested in what all these technicals and things that I'm using mean, feel free to tune into a lot of the other podcasts and different learnings I'm going to have coming out here this year to teach you more of how to actually look at this stuff, so you can use technical analysis and momentum to help you invest better or even trade better, because I use it a lot for trading, but it also from an investing perspective. So when we look at how the tech is doing this week, it's going to be under pressure. Last week, we got the unemployment numbers, which showed a tight labor market, showed wage growth was increasing, but also a slowdown in hiring. And when you have those two things, it shows a tight labor market. Well, with a tight labor market, what are people thinking? Wow, the Fed is going to continue to tighten. Let's go ahead and cut off this party that we're having, which brings me to kind of the investing mindset. And what I've been doing for clients is we know interest rates have to go back up. We already know the Fed is saying that they're going to do it. Now, how quickly they do it is the trick, right? May go up quicker, may go up slower. I'm of the mindset it's going to be a slow and steady pace, but they're very much going to stick to their word. So with that, there's a lot of areas in the market that, again, are more of a value play, more of your cyclicals that are going to do well when this happens, because, again, it's not free reign of money. From my perspective, between Congress spending and the Fed printing money and billions of dollars each month, it's kind of a sigh of relief to see them pull a little bit back, pull some of that alcohol off the punch bowl, right? Like, we've been punch drunk for 2-3 years. I mean, look at the S&P 500. It's up 81% in the last 3 years. I mean, that's huge, right? On average, I used to tell clients 10 years ago, because the last 5 years have been ridiculous. So I've been doing this over 15, but the last 10, I was able to say, hey, market average is 8%. You got to have that mindset. And I still encourage everyone to have that mindset. We are way over our skis. Now, that doesn't mean that we're going to see an immediate correction and that we're going to drop all the way back down to, ridiculously low levels. That's not what I'm saying. What I'm saying is that we do need to be cautiously optimistic moving forward, right? There was a lot of money in the system. People are doing way better off. Their debt load is way down. We're starting to see more of a gig economy. We're starting to see a lot of things that plays into the strength of an economy like this moving forward. But do realize that we still have been up 81% over the last 3 years. So I'm protecting you first. And then once we know we're good, let's take advantage of it. So again, from my mindset, the Fed does need to do this. We do need to stop spending. We do need to bring down congressional spending. Again, who knows if that will happen. But as of right now, we're seeing signs where things are going to go back to normal, which is what I'm hoping for. Okay. So when I invest and when I look at this for investors, what I'd say is keep an optimism, because the economy is still doing well. People are going back to work. People have more money than they've ever had. If they stop the punch bowl, how much do we really need to keep drinking anyway? Okay. Now, when I look at what's going on this week, again, from a trading perspective, it's going to be rocky. I'm looking at the pre-markets right now. Tech is going to be under fire again this week because of high growth PE stocks. People are just wanting to sell now and worry about it later, because, again, when you look at tech is up a tremendous amount over the last 3 years. So let's go ahead and get rid of some of the house money. Let's lock in some of those gains. From an investing, from a more of an institutional, just so you should know this, institutional money managers are rebalancing right now. They're also looking at, a lot of cash flow needs and things that people have at the beginning of the year. This is not an anomaly. If you go back and look over the last, even 10 years, you can see that almost every February, that's not the right one. If you look, let me go back, hang on. If you go back and look at the end of the day, when you get into this time frame for institutional investors, what they try to do is they try to unwind this time period to basically use this to their advantage. So if you were to go back and look at almost every start of every single year, even in the good years, these years, you're going to see these dips at the beginning of the year. It is what it is. There's also a January effect where they say that in January, typically at the end of the month, stocks rally after these rebalancing things happen. So these are not ingrained, going to be year after year things. However, if you take a look and you can see, again, that you see these minor corrections or these minor dips at the beginning of the year. So I look at that and say, okay, well, how realistic is that again this year? And now how far over our skis are we? So these are just things I'm thinking about. But when we come to what you want to be looking at from a trading perspective this week, I can tell you that you want to be careful of these high PEs right now. Now, you can still see a lot of good in them, in the sense of, if you look at Google, trying to type here. So if you look at Google, right, over the last 3, you can see some supports here around 2710. You can see some resistance here up here. The next real support that was actually tested, or resistance, I should say, that was tested, is somewhere right around here. So there's some room for it to move. And I'm going to do another video to keep this short on what are the trading ones that I'm actually looking at this week and how I'm looking at it. So long story short, watch out for the high PEs this week. There's still some good premium if you're on the options. There's a good opportunity for some swing trading because there is a bit of an oversell going on right now. So you can watch out for that. From an economic calendar, guess what? Earnings is upon us, people. We have earnings coming out at the end of this week. The big ones, the banks, start on Friday. I'm going to tell you, I believe they're going to have good earnings because interest rates have been going up. Their wealth management, all these different ancillary things to what the actual business, ancillary things to what the financial companies used to do, where they were just lending, has completely changed. Now we're starting to see different things that are creating more of that net interest spread with interest rates. So I believe that you will see good numbers from these financials. You may see some positive outlooks or some neutral outlooks, which may keep that upside contained. But we do have wholesale inventories, consumer prices, producer prices that are the main drivers this year. And then, of course, like I said, we have the banks coming out. So I do want to touch on a little bit more of the trading. I'm going to go into a couple of trades that I'm looking at this week. That will be another video that I'll go ahead and post here in a couple of minutes. As always, if you have any questions, feel free to reach out. Again, the email address is blackcreekwm@gmail.com. The website is blackcreekwm.com. And of course, if you want more of a personal relationship and you want to be a name and not a number, feel free to reach out to me. We can talk about what that looks like. But overall, God bless. I hope this was helpful. And I will talk to you soon. Take care.